Welcome back to the Deep Dive. Today, we're really going to get into the latest financials for IDEXX Laboratories. That's IDEXX. We're looking at Q3 and the year so far for 2025. Our job here isn't just, reading the headlines. We want to pull apart these filings, see what's really driving that amazing growth they've been reporting.
Exactly. It's more than just saying, oh, pet health is doing well. We need to pinpoint what's firing on all cylinders, especially that huge jump in instrument sales they saw. And importantly, figure out how sustainable this all is, especially when you factor in things like, well, big litigation payouts and those sudden tax law changes in the U.S.
Okay, let's start big picture then, because the numbers themselves are pretty commanding. For Q3 2025, IDEXX revenue hit, what was it, $1,105 million? That's a solid 12% organic growth rate. But the efficiency story, I think, comes from the earnings per share. Diluted EPS reached $3.40.
Yeah, and that $3.40, it's a 21% increase compared to last year reported. That's significant. It tells you they're not just growing sales, they're managing the business really well. The bottom line is actually growing faster than the top line. Strong operating leverage there. Still, that 12% revenue growth, a big chunk of that came from one area we definitely need to scrutinize, those capital sales, the instrument side.
Right, and this is where it gets really interesting. If you unpack that 12% growth,
Yeah.
it seems like almost everything points directly to their companion animal group, CAG. Their organic growth was leading the way, and the company points to, well, good sales execution, bringing in new customers, and seeing the benefits from all that R&D, that innovation.
Well, the model they have is, it's quite elegant, really.
Yeah.
Selling the instrument, the capital placement, that's just the first step, isn't it? The real money, the ongoing value, comes after the sale. It's that recurring revenue stream from consumables, the tests. Some people call it a consumption-driven ecosystem.
And the filings definitely show that ecosystem is firing. The recurring revenue from their vet lab consumables, up almost 16% organically in Q3. And the reason behind that demand, a solid 10% increase in the number of their premium instruments actually installed and active out there globally. It's that classic high-margin loop you see.
It really is that loop, almost perfected. But what's fascinating strategically, when you read between the lines in the reports, isn't just selling new machines. It's how the new machines are actively displacing some of their own older, maybe less strategic product lines.
Ah, you mean that internal shift, kind of a strategic cannibalization almost. Tell us more about how that innovation is playing out.
Yeah, you see a really clear contrast. Take their reference laboratory services where vets send samples out. That showed really strong 9% organic growth. Solid. But then you look at their rapid assay products, the simpler, quick test kits. That segment actually declined 5% organically in Q3.
Okay, a 5% organic decline. On the surface, that sounds like something went wrong, but IDEXX seems to frame it differently. Why is that?
Well, because the main reason for that decline was customers moving a key test for pancreatic lipase away from those simple rapid kits and onto their big in-clinic Catalyst instrument platform instead. This followed a new test launch specifically for the Catalyst, so they're essentially okay with a dip in the lower commitment rapid test sales if it means locking customers into that Catalyst platform. That platform requires the high margin vet lab consumables, right? It deepens the relationship. It's a very strategic choice, really, aimed at strengthening that core instrument base long term.
That makes a lot of sense when you frame it that way. And that push towards the in-clinic instruments, it leads us straight to the star performer this quarter. Capital sales. The CAG Diagnostics capital part, the instruments themselves grew by an incredible 71% organically in Q3. 71%.
71% is, it's phenomenal. But as a listener, you should immediately be thinking, okay, is that sustainable? Are they just pulling sales forward from future quarters? And while there's definitely strong underlying momentum, they did specify the driver, placing over 1,700 units of their brand new IDEXX InView DX analyzer just in that quarter. Clearly, this new device is hitting the mark. It's their current anchor product doing exactly what it's supposed to, starting that profitable recurring revenue cycle. But yeah, when you have comparison quarters that high, management really has its work cut out to keep showing growth later on. It sets a high bar.
That's always the challenge, isn't it?
Yeah.
But the reports also show they're not solely reliant on the companion animal side. There seems to be decent diversification. Let's quickly touch on the other segments.
Yeah, they look pretty healthy too. Livestock, Poultry, and Dairy LPD that actually posted surprisingly strong growth, up 14% organically, apparently driven by their core products doing well across the board, North America, Europe, Asia. Seems like those global food safety and regulatory trends are still a good tailwind for them.
And the water testing business, how did that fare?
Solid. 7% organic growth there. Came from a mix of higher prices, they realized, and also just selling more volume. And interestingly, they're using a similar playbook there too. Part of that higher volume came from placing new equipment, like something called the UV Viewer Plus. So it shows that instrument-led recurring revenue model isn't just for the pet side of the business.
Okay, good context. Now let's pivot to profitability, because with that massive 71% surge in instrument sales, and we know they're investing heavily in R&D, the big question is, are the margins holding up?
They absolutely are. And you can see how the maturing recurring revenue stream really helps here. Gross margin went up 80 basis points on a comparable basis, hitting 61.9%. The key takeaway for you is that the benefit from selling more high-margin stuff, those vet lab consumables, the reference lab tests, plus some strategic pricing, it was enough to offset the inflation hitting their costs.
Right, expanding gross margins is definitely tough in this kind of environment. What about operating margin? Especially since, as you said, they are boosting investment.
Even better, actually. Operating margin expanded by 120 basis points, comparable basis, reaching 32.3%. And they managed this even though they significantly increased their R&D spending, up 17.5% just in the quarter. The fact they can pour money back into innovation, which fuels their future growth, and still grow the operating profit margin, that shows really impressive operational leverage and, frankly, discipline.
And that discipline, that performance, it clearly translated into confidence about the future. They raised their full-year guidance for 2025, didn't they? Pointing to that Q3 momentum and the InView DX success.
Yeah, they're definitely signaling confidence in sustaining this. The full-year organic revenue growth outlook got bumped up to 8.8% to 9.5%. That's about a full percentage point higher at the midpoint. And the EPS outlook, earnings per share, that saw a big lift too. Now expecting $12.81 to $13.01 for the year. That implies 20% to 22% reported growth for the full year. Pretty strong.
Okay, let's shift to the balance sheet and sort of the financial engineering side. The reports mention cash on hand is a bit lower, around $208 million, and they've drawn on their credit line. Should that worry anyone?
Not really, no. You have to look at the whole picture. The key metric here is their consolidated leverage ratio. That's gross debt divided by adjusted EBITDA. It sits at just 0.65, incredibly low. What that means for you is simple. A ratio under 1.0 tells us they're using very little debt compared to the earnings they generate. This gives them huge financial flexibility. You could call it dry powder. They could make big strategic acquisitions or easily handle economic bumps without financial stress.
And they are definitely putting that financial strength to work, particularly for shareholders, it seems.
Oh, aggressively so. If you look at their capital allocation for the first 9 months of 2025, it was heavily focused on returns. They used nearly $810 million cash for financing activities, but the vast majority of that, almost $1 billion, $979.2 million, went straight into buying back their own shares. Very aggressive buybacks. And they're managing debt at the same time. They paid back about $89 million in senior notes during that period, too.
That underlying stability is really important when you look at their long-term picture. You flagged something earlier. I want to come back to it. $4.7 billion figure related to future revenues.
Ah, yes, that's a fantastic metric for understanding their stability and customer stickiness. That $4.7 billion isn't just wishful thinking about future sales. It represents the revenue they expect to get from multi-year customer commitment arrangements already signed. These are obligations customers have contractually agreed to, things they will purchase over the next 2 years. It gives management and investors a huge amount of confidence in the company's sort of baseline revenue, regardless of short-term market noise. A real anchor.
That's a great way to put it, an anchor. And that stability is crucial when you have unusual things hitting the financials. Yeah. There were two big ones we should probably clarify: the litigation payment and the tax law change. First, the litigation.
Right. So they settled a major litigation case back in April 2025. It resulted in an $80 million cash payment during the first 9 months. Now, the important thing for Q3 results specifically is that the expense for this was already booked or accrued in previous years. So while it was a significant chunk of cash going out the door, it didn't actually hit the Q3 profit and loss statement as a new shock expense.
Okay, so cash outflow, yes, but P&L impact was historical.
Got it.
Yeah. The tax law change. These things are always tricky in filings, right? Often the accounting impact is different from the cash impact. Can you simplify what happened with the R&D expensing change?
Absolutely. It's a classic example. So the U.S. government brought back the rule allowing companies to immediately expense their domestic R&D costs for tax purposes, starting basically now. Now, for accounting rules, weirdly, this actually contributed to a higher reported income tax expense on their P&L statement in Q3. Makes the accounting profit look slightly worse on that line. However, the much bigger impact, and the one that matters more for the business day to day, is the cash flow benefit. By letting them deduct those R&D costs sooner, the change is expected to cut the actual cash taxes they pay this year by about $105 million.
Okay, let me make sure I understand that for the listener. The accounting line item for tax expense looks a bit higher in Q3,
Yeah.
but the actual cash they get to keep instead of sending to the IRS this year is roughly $105 million more because of this change.
Precisely. It's textbook accounting noise versus cash reality. They got a significant cash flow boost from that policy change, freeing up cash they're now using for those buybacks and further R&D.
Okay, so pulling this all together then, IDEXX looks like it's firing on, well, pretty much all cylinders. Rapid growth, driven by getting instruments like the InView DX analyzer placed, which then fuels that incredibly profitable recurring revenue from consumables and lab services. It's a powerful cycle.
It really is. And they're managing it with really impressive financial discipline. We talked about the margin expansion. And they're targeting very high cash flow conversion, too, aiming for operating cash flow to be 105% to 115% of net income, converting more than your net income into actual cash. That's the sign of a really efficient business model, light on working capital needs. So yes, investing heavily in innovation, returning tons of capital, all while having that massive $4.7 billion anchor of future committed revenue. It's a strong position.
It definitely paints a picture of strong momentum. So given this incredibly successful loop they've built, place the machine, sell the high-margin consumables, for years we have to ask what's next? What's the next big thing? The next IDEXX InView DX analyzer that could drive the next wave of those capital placements and long-term commitments.
Well, the filings themselves drop some pretty big hints, I think. It looks like the next big frontier might be in their software and data ecosystem. We saw their recurring revenue in veterinary software grew over 9% organically, right? And they mentioned that's fueled by expanding their SaaS software as a service installed base. They've also been buying software companies, data platform businesses, things aimed at practice management systems, delivering data insights. So perhaps the next big lock-in for customers, the thing that drives those next multi-year contracts, might not be another physical diagnostic box. It could be, advanced AI-driven practice management software, or maybe tightly integrated diagnostic imaging software platforms. Tools that become so essential to how a clinic runs day to day that they create the same kind of commitment revenue that the diagnostic instruments do now. That integration of diagnostics, software, and data that feels like the next big wave for you to watch.